Do you know the basics of a loan, or have you ever felt overwhelmed when trying to understand the different types of loans available? These are common questions, and today we're here to demystify the world of loans. It's crucial to grasp the fundamentals of loans, particularly if you're a financial enthusiast or simply want to make sound monetary decisions. Loans are not just about borrowing, they're about strategizing, planning, and understanding your financial position. In this video, we'll delve into the various kinds of loans that exist, from personal and student loans to mortgages and auto loans. Each type has its own set of rules, benefits, and drawbacks, and we'll explore them all, giving you a comprehensive understanding of the lending landscape. By the end of this video, you'll have a solid understanding of loan basics, which will help you make informed financial decisions. So, let's get started and master the basics of loans together. So, what exactly is a loan? In simple terms, a loan is a sum of money that you borrow with the promise to pay it back. It's a financial agreement between two parties, the lender and the borrower. The lender could be a bank, a credit union, an individual, or any other financial institution. The borrower, on the other hand, could be an individual or a business. The lender provides funds to the borrower, who then uses this money for a specific purpose. It could be anything from buying a car, a house, or funding a business venture to covering unexpected expenses. The borrower agrees to repay the loan, typically in regular installments over a set period, also known as the loan term. Now let's talk about interest. It's the cost of borrowing money, and it's how lenders make their profit. The interest rate, often expressed as an annual percentage of the loan amount, is determined by several factors, including the type of loan, the term of the loan, the creditworthiness of the borrower, and the current market rates. The borrower pays back the loan amount, called the principal, plus the interest. So if you borrow $100 at an interest rate of 5% per year, you'll have to pay back $105 at the end of the year. Repayment is the process of paying back the principal and interest of a loan. Payments are usually made monthly, but the frequency can vary depending on the loan terms. Each payment reduces the loan balance until it's completely paid off, also known as loan amortization. It's important to note that not repaying a loan can lead to serious consequences, including damage to your credit score, legal action, and loss of collateral if the loan is secured. Now that we've defined a loan, let's dive into the different types of loans. There are several types of loans, each with its own set of terms and conditions. Let's start with personal loans. These are general-purpose loans that you can use at your discretion for things like consolidating debt or paying for an unexpected expense. They are typically unsecured, meaning they need no collateral, and are based on your creditworthiness. Next up, we have auto loans. These are secured loans, specifically designed to finance a vehicle purchase. The car itself usually serves as collateral for the loan. These loans are typically offered by dealerships, banks, credit unions, and online lenders, with terms that generally range from 2 to 7 years. Moving on to home loans or mortgages, these are used to buy or refinance a home. They are secured against the property, meaning if you fail to make payments, the lender could take possession of your home. Mortgages come in different types, with fixed rate and adjustable rate being the most common. Then, there are student loans, designed to cover the cost of higher education. These loans come in two main types, federal and private. Federal student loans are funded by the government and offer fixed interest rates, while private student loans are provided by private lenders and may have variable or fixed interest rates. Finally, we have small business loans. These loans help entrepreneurs start or expand a business. They can be secured or unsecured and come in various forms, such as term loans, lines of credit, or invoice financing. The terms and conditions for these loans are often based on the business's financial health and the owner's creditworthiness. Each of these loans has its own unique features, and the one you choose should align with your financial situation and objectives. For instance, if you're buying a car, an auto loan would be appropriate. If you're starting a business, a small business loan could be the way to go. Understanding the different types of loans will help you choose the right one for your needs. So, how does one get a loan? Well, the loan process may seem daunting, but it can be broken down into a few simple steps. First comes the application. This is where you provide information about yourself and your financial situation to the lender. You'll need to supply details about your income, employment history, and current debts. This is also where you'll specify how much you want to borrow and what you plan to use the loan for. Next, the lender will evaluate your application. They'll look at several factors, including your credit score, income, and debt-to-income ratio. Your credit score is a numerical representation of your creditworthiness based on your past borrowing and repayment history. A higher score indicates a lower risk to the lender. Your income and employment history give the lender an idea of your ability to repay the loan. The debt-to-income ratio, on the other hand, is a measure of your monthly debt payments relative to your gross monthly income. Lenders use this ratio to assess your ability to manage your monthly payments and repay your loan. The lower your ratio, the more favorably lenders will view your loan application. Once the lender has evaluated your application, you'll receive a loan offer. This will detail the terms of the loan, including the interest rate, repayment schedule, and any fees or penalties that apply. It's crucial that you read and understand this agreement before you sign on the dotted line. If there's anything you don't understand, don't hesitate to ask the lender for clarification. After you've accepted the loan offer, the funds will be dispersed. Depending on the type of loan, the money might be sent directly to you, or it might be applied to the specific purpose for which you're borrowing. And there you have it, a simplified walkthrough of the loan process. From application to approval, each step is essential in securing the loan that best suits your needs. Remember, understanding the loan process is key to securing the best loan for your needs. Repayment is a crucial part of any loan. It's the part of the process where you start paying back the money you borrowed, plus any interest accrued. This is typically done through monthly payments over a set period of time, known as the loan term. Let's break it down a bit more. Imagine you've borrowed $10,000 for a 5-year term. Each month, you'll make a payment that goes towards reducing that $10,000. But that's not all. The payment also covers the interest, which is the cost of borrowing the money. The interest is determined by your interest rate, which can be fixed or variable. A fixed interest rate remains the same throughout the loan term, while a variable rate can change based on market conditions. Now, you might be wondering about the size of these monthly payments. Well, that depends on the amount borrowed, the interest rate, and the length of the loan term. Generally, the longer the term, the smaller the monthly payments, but the more interest you'll end up paying over time. Let's talk about what happens if you miss a payment or pay late. It's not a situation you want to find yourself in. Late or missed payments can result in additional charges and can negatively impact your credit score. A lower credit score can make it more difficult to get approved for loans or credit cards in the future. If you're having trouble making payments, don't panic. Reach out to your lender. They may be able to adjust your payment plan or provide other forms of assistance. It's in their best interest for you to successfully repay the loan, after all. Remember, it's not just about getting the loan, it's about managing it responsibly. That means understanding your monthly payments, keeping track of your loan term, and making sure you pay on time, every time. Being diligent with your loan repayments can help maintain your credit score and avoid additional charges. So take the repayment process seriously. It's an important step on your financial journey. We've covered a lot of ground today, so let's recap. We delved into the world of loans, breaking down the concept into bite-sized pieces. We started with the basics, defining a loan as a lump sum of money that you borrow with the promise to pay back the same amount along with some interest. We then explored the various types of loans, from personal and student loans to mortgages and auto loans, each with its unique set of terms and conditions. We also examined the loan process, starting from the application, approval, all the way to the disbursement of funds. Finally, we underscored the importance of repaying a loan. We emphasized that timely repayments not only help you maintain a good credit score, but also potentially open up opportunities for future loans. Remember, understanding loan basics can help you make smart financial decisions. Thanks for watching, and keep exploring the world of finance with confidence.